Welcome to Everything Money. Today we are talking about the pharmaceutical company Merck. We will show you the financials behind this company and where they're going with their money making, how it translates into a stock price. We'll use our stock analyzer tool and our software to show you all of this to see what you should be paying with this company moving forward. And if you want to trade this at a quicker pace, you can join the handsome Mo in the Bid and Ask Nation. He will show you the trends and the charts. But first, why should you be listening to us? I bring your questions to a couple guys that own and operate over $100 million of real estate, many businesses and stocks. They will show you their thoughts on how you should be investing at home. I give you Paul Gabriel and his thoughts on Merck, baby.
Thank you, Uncle Seth. Follow us on Instagram, new Everything Money account, and then also follow us personally so that we don't feel left out. So guys, this is our Everything Money software. I'm going to click on the 8 pillars tools. Merck, right here.
Now, obviously, they're making the COVID stuff, Paul, and they're coming out with new pills. The U.S. is ordering millions of more pills. They're loving this stuff.
Sethy, look at this.
Give it to me now.
Another company that you go back to 2000 and it hasn't hit its peak yet.
Hey. We bring up companies like this, folks. Intel, Cisco. We found Micron today. The companies that reached an amazing high. All the YouTubers back in 2000 would have been pumping this rocket emojis all the way up. And sure enough, many years later, with their revenue quadrupling, their profit quadrupling, their stock price goes nowhere, and you have made $0 over 2 decades. Tell them why, Paul.
Well, I want to show this. Let's go to the income statement right now. Last year, Merck did $54 billion in revenue.
Jeez.
In 2000, they only did $37 billion. So look at this. In 1992, they did $9 billion. In 2000, they did $37 billion. 4 times growth. From 2000 to now, they didn't even double.
Nope.
Only a 50% increase overall in revenue. These things happen. This is what happens, guys. When companies get bigger and bigger and bigger, it's harder and harder to grow fast. Okay? So back to the 8 pillars here. Let's go to the main page, metrics. This is a $209 billion company. First pillar, we want the 5-year PE ratio to be under 22.5. It is 30.5. Okay? We take a second one. We want the 5-year return on invested capital to be greater than 9%. It's 11%. So we have 1 X and 1 check. This 11% says that they take their invested money in the business through the debt and equity, and they get a good return on that. So that's a big positive. Sethy, what do we have here?
Give it to me now. How about a hug?
Yield.
Oh, twice the market?
More than twice. It's 3.1%. It's 2.5 times the market. Now, what you're not going to hear from people is how safe is the dividend? Well, the dividend's only as safe as the free cash flow to support it, right?
I don't think many people know that, Paul. I surely did not. I just thought it was just getting cheddar every month for, is it every month or is it quarter?
Quarterly.
Okay, go on, Paul.
Why are you laughing?
Well, Paul, I like when you use the chickadee check more often.
Chickadee. Okay, so I will start incorporating that back
Please
again.
do. Go ahead.
Right above the dividend, we have the 5-year average free cash flow and last year's free cash flow. Seth, look at this.
What you got?
7.4 and 8.2. So guys, they're paying out a big chunk of their free cash flow in dividends. So remember, we'll get to it here at the end about the cash flow statement, but cash flow is used for one of 5 things: paying dividends, buying back shares, paying down debt, making acquisitions, reinvesting back in yourself. They're paying out 80% of their cash flow to dividends, maybe even more than 80%. That doesn't leave much room left over for other things. So something to consider. But again, back to it, 1 X and 1 check. Pillar number 3 is the revenue growth that we want to see. We click on the income statement. We go over 5 years. 39.8 to 54 billion.
Very nice.
Check mark there. But remember, in 2000, they had 37 billion or 38 billion in revenue. So they haven't grown much over the years.
No,
they probably sold some things off, etc. Plus, they've lost drugs in their pipeline. All these things. What matters a lot here is the pipeline of the company. So go look at the pipeline. Seth will pull it up. Mm-hmm. They'll have it on their website. They'll talk about on their 10K. They'll talk about the pipeline of what drugs are coming up to see how their revenue can look in the future.
Pillar number 4 is profit growth over the past 5 years. Let's take a look at that.
So the same income statement, I just scroll down a little bit. I go to net income, 2.85 to 7.2 billion. Check mark there. Wow. Okay.
Wow, Paul. Phase 2 is 52 different programs, 24 phase 3 programs, and 3 under review.
So keep this in mind, guys. Phase 3 has a 55% approval rate. So at that level right there, they have 14 or 15 drugs. The question you have to ask yourself is, how good are those drugs? How marketable are those drugs?
Mm-hmm. How much revenue do those drugs drive?
Yes.
Because
correct.
there's a lot of drugs out there that basically you can treat like 17 people in the population. And I'm not exaggerating. And drugs, people do that.
Are you serious?
Yeah. I mean, there's rare diseases out there that companies do make a drug for, and there's really nobody to treat. So
I see.
yeah.
All right. So pillar number 5, guys.
Shares
is
outstanding. Yeah,
shares
go ahead.
outstanding. This is an important one because I consider it a silent killer. We want the shares staying the same or going down. Because if they're going up, they're diluting you as an owner. They're giving you less and less of the pie. They're giving you less and less of the revenue percentage every single year. So we go to the bottom of the income statement, listed right here. 2.73, 2.53. Check mark there. So they're not diluting their owners. Check mark. Chickadee check.
They were not. I'm surprised.
I am too.
Pillar number 6 involves their debt. We'll look at total long-term liabilities. Paul, go ahead. Show us what's up.
So guys, the debt levels are just like your personal life. The more debt a company has, the less likely they are to withstand a recession. If you spend all your money and you have lots of debt, and then all of a sudden a recession hits, you lose your job, you're probably going to declare bankruptcy, or you have a higher chance of such. Same with companies. So I created this metric. I go to the 5-year average free cash flow on our on our main page of our software. I multiply it by 5, $37 billion. So I want their long-term liabilities to be under $37 billion. So I go to the balance sheet. I scroll to the bottom. 33.9. Check mark. It's 37 is greater than 33.9. So they barely have the check mark there, but nonetheless, if they stop paying their dividend, stop doing acquisitions, stop buying back shares, and they just pay down their debt, in less than 5 years, they would have no long-term liabilities anymore.
Pillar number 7 is the grandpappy of them all. This is free cash flow. We want their free cash flow growing, and we will translate this free cash into an appropriate market price we want to pay for this company.
So guys, we go to the cash flow section of our website, scroll a little bit. Free cash flow is cash from operations less your capital expenditures. And like I said earlier, it does 5 things: pays dividends, buy back share, pay down debt, make acquisitions, and reinvest back in the business, right? So I added this line, cash from operations less capital expenditures. I just added this line to make it easy for you, so it does the math for you. 5 years ago, 4.34. Last year, 8.16. Check mark there. Average over the last 5 years, 7.4. We multiply it by 20 as a metric to start at what value we want for the company. That is equivalent to $148 billion.
Yeah, the actual market cap is 209 billion.
So this is an X. It's selling for a higher multiple than this metric allows. Now, if the company was growing fast on its own, you can justify a higher multiple. But it's Merck. They're already pretty large. In the last 20 years, their revenue has only gone up 1 or 2% a year, essentially.
It's not going anywhere.
It's not going anywhere. So you have to apply a much lower multiple. When we use the stock analyzer tool next, you will see what I mean by that, because every investment is the present value of all future cash flow.
Paul, it's hard to consistently not think that better days are ahead. Maybe something, I guess an optimistic person always thinks maybe something great's going to happen, but you'd rather think like...
But what's optimism, Seth? This is a very common misconception. Optimism isn't unbridled enthusiasm. It's not this like, everything's gonna be great. Optimism is saying, hey, there will be hurdles, but I think the future looks better than the future looks better than today. Great. Awesome. When you get married, you're getting married because you think to yourself, I'm gonna have a better life with this person without. Does that mean there are gonna be hiccups? Of course there's gonna be hiccups. But you're saying that it's gonna be better than, that's being optimistic. Now, if you guys didn't like the numbers because it takes too much time to do, which I don't blame you, we have the 8 pillars tab here. It shows all the checks and X's. Seth, look at this.
Oh, we know where this is headed.
It's the valuation metrics. Too expensive, guys. Everything else we like, it's just too expensive.
Yeah, Paul's saying we like this because as value investors, we want to find a great company and then just find it cheap, and then we invest. And at the moment, it is not, but we'll look at the stock analyzer tool now, the next step of our software, to maybe put a price target on what you should be paying for Merck moving forward. Go ahead, Paul. What do you think?
So, guys, we go to the stock analyzer tool. We put a number of years of analysis. First off, I put in 10 years because Merck's going to be around for a long time. You can select 1, 2, or 3 assumptions. I'm putting in 3. Okay, first one, my assumptions. Low. I'm going to go with 0, 1, and 2% revenue growth. That sounds crazy. I get it. But look at their 10-year number and look at their 20-year number.
1.4.
Yeah, I'm just going to assume low. Profit margin, 13, 14, 15%. Free cash flow margin, 15, 16, 17%. PE, you're not going to like this, guys. 9, 11, and 13. Never forget. 9, 11, and 13. And the desired return, 12.5% a year. So guys, why did I go 9, 11, 13? Because there's no growth here. No growth. No growth. I'm only going to make my money off of paying down debt, buying back shares, and getting my dividend. That's all I'm going to get. That's the only way I'm going to get my return here. So I have to pay a low multiple for that. Okay? So I get 12.5% because if I invest in an ETF, I'll get 9 or 10%. So give me a reason to invest in individual stock.
Yeah, this is
And I want a margin of
riskier.
safety.
It's less diversified.
Yeah, give me a reason. I want margin of safety. Hit the analyze button.
Come on, baby.
Oof.
Current stock price is $82.
And I'm looking at it roughly around $40 or lower.
Yikes.
You might sit there and say, Paul, you're crazy, guys. There's no growth in this company. Now, if you look at their pipeline and think, oh, this pipeline looks incredible, and they're going to have monster revenue growth in the next 10 years, great. We don't know that yet, though. Now, with a company like Merck, where valuation is the only thing that matters, and by the way, look at the valuations.
Yes.
Did you see that?
Show them
It
again.
was about double where the market should be.
I see.
And the price falls in half. It takes about $40. It actually makes sense with the valuation of the company that it should be selling for half.
If this resonates and makes sense in your mind, you can have this software behind Paul. You can join our community right now. Have it in the palm of your hand. Paul, tell them what to do, baby.
So we created this because our users wanted to be able to research their stocks without waiting for us to make videos on them. It makes perfect sense. So we created all the software. You get everything here. Plus you get everything that's coming soon. You get access to Seth Moe and I. You get exclusive daily content, 2 or 3 videos a day. But most importantly, you get access to the community of people to talk to, over 6,000 people to talk to about your investment ideas. Because like them, you're probably alone in your own island amongst your friends and family who don't believe in what we're saying here. And I get that. You can talk to them. This is only 90 cents per day. If you're just able to make an extra 1 or 2% a year or save 1 or 2% a year off your losses, this will make you hundreds of thousands, if not millions of dollars in retirement. And it's only 90 cents per day. 2 ways to sign up, everythingmoney.com, Patreon. The benefit of everythingmoney.com is no sales tax because we're not big enough yet, and you don't get double charged in the first month. Sign up, 90 cents a day, no brainer.
If you want to trade Merck at a quicker pace, you can join Mo. He'll show you the charts on a daily basis in our glorious Bid-Ask Nation, and Mo is your fearless leader. Mo, what's going on over there?
Interesting resistance point that it has here, that it's broken through a couple times right here, but it fell back down. And again recently, and it fell back down. So you see that whatever, and this is dating back to 2019. So there is a very strong resistance point here that it's trying to break at maybe $83. Guys, I talk about gaps always filling. So
look at this chaos.
Recently, that gap happened, and it closed, and the gap filled. This gap just happened on earnings. So I assume that at some point this is going to climb back to the top. But listen, this gap might take a while to fill because it's already over that 82 level, and now it has to go to an even higher number. So what would I do? I would take it right over here, take it to a swing trading chart, and just follow it on a day-to-day basis and try to make some money off of it. Right now, it's definitely a short position. You can try to short it down to the 100-day moving average, maybe bounce it back up here. If this is the kind of pattern recognition that you want to learn from, come and join me in the Bid-Ask Nation. You can learn how to trade long-term, short-term, day trade. It's a place to come if you want to make some money and not sit on your hands and just wait from a value investing standpoint.
That's our take on Merck. Stay with us. We'll update this company moving forward. Join the community, get the software, and you can talk with like-minded people about this company moving forward. So that's our take. Fondle thumbs up on the way out. We'll see you next video. Thanks for watching.